Let's discuss market valuations, new theme and ideas with Nilesh Shah, CEO of Envision. Nilesh, fantastic to have you back. Thank you for joining us. Well, this market is getting somewhere immortal. So much of bad news has been thrown at us and markets are just not reacting to it.
Yeah, I think the only answer for that is liquidity. I think there is a fair bit of liquidity coming in, which is getting driven by greed. There is basically investors are looking for short-term gratification. And I think that's really driving markets to levels which I think are, I don't think these valuations in a way are sustainable.
So are you making a call for a fall, correction or a crack?
I think a correction, I think there's a very high probability of a correction. I'm not quite sure if we are going to be in for a crack or a severe crash, but definitely I think these levels of the market, the kind of froth that you see, the kind of exuberance that you're seeing in the IPO market, these are all symptomatic of the markets being ready for a correction.
How steep could the correction be, Nilesh? I mean, could we see a 5–10% correction, or do you think the fall could be more exaggerated than that? Because while there are domestic issues like the IPOs, our own valuations, earnings still a question mark, there's also geopolitical tensions which at some corner they would spring up whenever they have to.
Well, at this stage, I think it'd be suffice to say that probably a 5 to 10% correction is something which is quite possible. And we've had those kind of situations several times as we've kind of traveled through this bull market. So I think a 5 to 10% correction is quite possible. At this stage, you don't see enough indicators or levers to say that there's going to be a correction beyond a 10% correction, because I don't see any reason why liquidity is going to go away. Interest rates in India remain kind of low. Other asset classes aren't available in the sense that the outlook for other asset classes is not yet very positive. And that would mean and imply that you're going to see savings continue to come into the equity markets. And that's something which is basically going to help our markets to hold up, even if there's going to be a withdrawal by the FIIs, which has been the case for the months of August and September. But I think domestic liquidity has given tremendous support. So it looks like that over the next 2 to 3 months, we could see a 5 to 10% correction. After that, it's going to be over to earnings. And earnings will have to start kind of flowing in to kind of support the market. So it won't have to be just liquidity, but I think as we step into calendar year 2018, it will have to be both liquidity and earnings which will have to support this market.
Right, but what would lead to that correction? Would it be more, the global risk with geopolitical tensions, or local disappointment with, the macro performance? Because as we understand, I think you've also highlighted that populist policies will help with demand. If the government is coming out with stimulus, if they're helping the currency, that would support, because I don't think we can afford one more bad number on growth. We've already seen one disappointment on growth with the Q1 numbers, but one more number would really hit sentiment hard. So I think the government is stepping in and managing that risk to a certain extent. So where do you think the derailment will happen?
Well, what it looks like, I think, is that over the next 12 to 18 months, we're going to definitely see the government get a lot more bold with the fiscal spending. It's unlikely that the fiscal deficit situation will improve further from here on. If at all, the government could take some risk, unveil measures to stimulate the economy, which will mean higher spending, which means the fiscal deficit is likely to slip over the next 12 to 18 months. When that happens, you're going to see some pressure on the currency, you're going to see some pressure on interest rates, which means that will make the banking sector a little more vulnerable. I mean, if you really look at from a very macro perspective, when you see slippages on fiscal deficit, or you see some pressure on interest rates or pressure on currency, the banking sector gets in a way hit from a market standpoint. Today, the banking sector has a very huge weightage in the indices, and that itself, so clearly what it looks like is that for the next few quarters, we are going to probably see some pressure on the banking sector, which in turn could put a pressure on the market indices.
Okay, so I'll tell you what, since the India story or rise of India, what we are celebrating is just a function of the way how our economy is developed and how things are moving. So the biggest construct for this bull run is that Indian savers are making a comeback, and the percentage allocation of Indian saving is now migrating and quite smartly and handsomely back into equity. So Nilesh, you may want to pay attention here. These are some special graphics what we've done. That is how the household saving in equity has moved. Now this includes a little bit of mutual funds, but this does not include the balance funds. The point I'm trying to make here, Nilesh, is that markets may be at an all-time high, but the percentage of allocation into Indian equities is still very low. And the orange chart, the Nilesh, is property, where we still have about 55% exposure. 16% is still with 16% is still in bank deposits, and a fat 12% still sits in gold. So Nilesh, these headline numbers are telling me that don't worry, there is a tsunami of money which is going to come. What you've seen may be looking like a fat SIP number of $10-12 billion, but this is just the tip of the iceberg. And when demand is more and supply is less, which is good quality paper and good blue chip companies, markets are not going to correct even by 5, 7, 10%.
Yeah, so I think, as I was saying, is that liquidity is something which is going to be hugely supportive of this bull market. And therefore what it implies is that the bull market is likely to continue and sustain. But along the way, you are going to have intermittent corrections of 5 to 10%, just because some other segment of the market begins to sell.
Have you raised cash in
I think it might just be a good idea to kind of have some bit of cash. So I think we will definitely evaluate that some of the positions which have done well. I think it might be a good idea to take some money.
Taking some profits off the table?
So I think we have some investments in areas like engineering, real estate. That's the kind of pack where we probably might kind of want to kind of just use this current opportunity to raise some bit of cash. But it's not something where we're saying is that, for the next now, the best is over. You're not going to see this bull market sustain for a longer term. It's not like saying is that we're definitely not in 2008 kind of a scenario. We could be somewhere where we were in 2011, 2012, 2013, where you could have some pause before we resume the uptrend again.
Okay, great to hear that. When that correction comes, Nilesh, do you think it's the froth which is going to come off the first, the real estate, the IPOs, the NBFCs, some of the consumption names, or do you think it's going to be a more across the board linear kind of fall?
I think it's going to be more across the board, but some of the sectors which could be more vulnerable could be some of these very richly valued private banks, HFCs, NBFCs. This is really the segment where there is a lot of froth. I think some of the companies which are into infrastructure services, some of the contracting companies and all of that, where suddenly investors have started to believe that these are companies which are very strong, which generate cash flows. But if you kind of dig a little deeper, what you find is that investors are just focused on the top line growth and extrapolating that, but you're really not looking down below and seeing that, okay, are these companies generating cash flows? No. The big benefit these companies have got is basically savings and interest rates. It's not operating performance which is improved significantly or dramatically.
Are you talking about the government-linked ones or the private ones?
Both, because finally you're dealing with the government. Even if you're a private company, you're dealing with the government, because that's really where the investment is happening. The public investment is happening there only. So be it companies in roads, rails, all of that segment. I think there we are seeing is a lot of these companies which were trading at single-digit P multiples are now trading at 30, 40, 50 P multiples and are getting priced as if these are going to be growth stocks and cash flow generative companies for the decades to come. And I think that's really where a fair bit of exuberance is coming. Not to say that they're going to reverse back to single-digit P multiples, but I think even if a 40 P multiple comes down to 30 P multiple, that would be a good shave off.
Right. So let's talk about that. You're essentially saying the lenders are not the right sectoral play, that they have high valuations. For a lot of our viewers, and we've seen the way housing finance companies have rallied. Today we have Reliance Home Finance coming on board, where there's all this talk about there being a slight bit of discount to the already expensive players in the market. What would you tell them in terms of the risk that there is to the business that they are perhaps overlooking right now?
Yeah. So I think in a way, for HFCs and for most lenders, it's the quality of your book which determines your valuations over a period of time. Growth and quality, which means growth in earnings and quality of your book, I think are the two things which have to go hand in hand. The problem is growth is something which you can see in the short term. You can see it over a few quarters, over 1 or 2 years. Unfortunately, asset quality is something which you start to see only after 3 or 4 years. And that's really when, so the bad news comes last. And that's really where the biggest challenge is. And I'm not quite sure if some of these HFCs have really the best risk management practices. For a lot of them, the growth in loan book has come in from construction finance and loan against property. And that's definitely a vulnerable segment. And one has to keep that in mind.
So Nilesh, are you making a case that one should avoid retail franchises whether it is Bajaj Finance or it is HFCs or any like a Capital First, because what we've seen is that we've seen the corporate side of the economy, it has taken a hit, and that is where the cleansing and the recovery has started. The retail lenders have been in a bull run, and companies who are retail facing, whether it's HDFC Bank, Bajaj Finance, they've had it good.
Yes.
Now can the wheel reverse?
It could potentially reverse, but I still think there's going to be some kind of a gap in between. It's not going to be that the retail story is going to end today and the corporate loan book story is going to start reviving from tomorrow. The way we understand is that on the retail side, some of the excellent franchises, they're trading at crazy valuations. They're trading at valuations like 50p multiple or 5 to 10 times price to book. The challenge there is valuation. Sorry?
What is trading at 10 times price to book?
I think one of the names that you mentioned is close to that level, right?
Bajaj Finance is 6 times or 7 times.
It depends. You're looking at forward or you're looking at trailing. Okay? So if you look at trailing, then it's 10. But if you're growing at 40-50%, then that translates into 6 times.
So you can talk about stock which you don't own. Let's talk about that, right?
No, so I think that's where. I think on the wholesale side, I still probably about another 3 to 4 quarters of absorbing the credit costs are going to be there. As they kind of solve problems, as they resolve their asset quality issues, there are going to be costs which you will have to absorb. So the wholesale lenders could be faced with that kind of a situation.
So this is where the bubble will burst. But when that correction happens, what do you buy? That's the key question.
So I think at that point of time, buy quality names in this space. So I think the long-term lending story
buy NBFCs again?
Yeah, absolutely. Because when you see corrections, you will see corrections which are of the magnitude of 20-30% in these kind of stocks. When that kind of a correction happens, it would be a good time to step in and invest into some of these quality lending or retail franchises.
So these growth stories are intact, you just have a problem with the valuation.
Oh, absolutely. I think the data still suggests India is still underbanked, underinsured, underinvested, whatever is basically the right adjective. I still think that very much holds true for India. I think these are structural opportunities, and these structural opportunities are intact. It's just that on one hand, the investor has to be cognizant of the valuations that he is paying. When valuations become more reasonable, more affordable, that's really the time to invest and kind of then hold those positions for a few years.
So, I'm curious to know, you've been a long fan of IT, and you still believe that IT is actually a buy and things are turning around for the sector?
Yeah, so I think the value, so what's happening with IT? Look at it. I think the biggest customer segment is the US. US is still a very vibrant economy. US is still doing very well. Spending on technology is going up, right? Therefore, the need for IT services in some of the emerging areas is still there, right? I think so, that is one. Two is the problem which IT faced was the currency. The last 12 to 18 months have been very unfavorable. One is not quite sure if you're going to continue to see weakness in the dollar. It's quite possible that the dollar strength, and we've seen this over the last 1 or 2 days, it's quite possible that strength in the dollar could come back, second. Third is that there is some kind of pricing adjustment which is really happening, and some of the newer areas are becoming now bigger in terms of their share or in the share in the overall revenues. So that will basically drive margins. The fourth is these are cash-rich companies which are doing a lot of buyback. So if you look at the big theme in America 5-7 years back was a lot of companies were doing buybacks, and investors just chose to ignore that. And some of these companies, not necessarily from the technology space, but from the old economy space in the US, these are companies which have done well as stock prices over 5 years.
But the buyback can only do that much to arrest the fall of the price, stock price, right?
Yeah, so I think that is one, and two is the valuations. Look at it, what are you paying? I think the rest of the market, if you take out IT, the rest of the market is trading at what, 30-35 times P multiple, IT is trading at maybe 15-16 times. There's a huge gap, and is there a tremendous rate differential? Leave aside the retail lenders, but rest of the pack, earnings growth we all know is still in single digits. So is the case with IT companies. These IT companies are not degrowing. They're growing only in single digits, but they're not degrowing, whereas rest of the pack is also on an aggregate basis is growing in single digits. So why do you want to pay 100% premium?
Are you being a contrarian here?
I think so. I think it makes sense. I think these are levels. We've seen a lot of bad news with the entire sector, specifically with a few companies.
You find it hard to convince your clients on the same story?
No, I think as long as you believe that the specific company that you're investing in has a bit of a differentiated business model, the growth rate could be better than in the industry growth rate, valuations are reasonable, the balance sheets are strong, balance sheets are intact, the return ratios are fantastic. I think this might just be a good opportunity.
What have you acquired last?
No, I think in the IT space, the only one which we have invested in is Persistent. We still like
That's
that.
for 3 years now.
Yeah, it's probably a little longer as well, but we continue to like it. I think it's a pretty strong visionary management. They've taken a lot of changes. They've taken a lot of initiatives to change themselves, change the business model. They've struck the right alliances. It's now honestly a time when probably the results of this, the outcome of all of this is something which you'll start to see over the next few
flavor
months.
Sorry, are you
of
talking about Infosys?
In Persistent.
Persistent.
He is not going to buy Infosys. He runs a mid-cap fund. So Infosys is.
Yeah.
He'll comment on Infosys,
But he's
but
an
not buy
old-time
in the.
fan of Infi.
You know, I was looking at Infosys data. The stock is now giving you a dividend yield of 3%. I don't remember when was the last time we thought that, okay, buy an IT company because there's a dividend yield available of 3%.
But that's his peg as well, right? That you can't compete with IT companies when it comes to, their cash ratios and their dividend payout.
No, they've increased now because stock's not gone anywhere and they've started paying a lot of cash back or buyback, so the EPS suddenly comes down. So
I think the key thing is that these valuations you can't afford to ignore. It's like this.
But can they go through a 2-3 year time-wise correction where they may not fall,
Right.
but you may not make double-digit returns in the next 3 years? All I'm saying is that I understand your logic. That look, the
I would be
downside
very
is limited.
surprised if that were to happen. Let me put it this
Even
way.
large
that,
cap can give double-digit
I'm not too sure about the large caps. I'm not too sure because some of the large caps have their own set of challenges and all of that, the leadership related issues and all of that. But I think you step down and look at some of the tier 2 companies. I think some of these tier 2 companies could give you double-digit returns over a 3-year
I have
time
a follow-up question. Give me a construct of your portfolio. How much IT, how much pharma, how much? Just give me a construct of your portfolio, and then I'll frame my next question.
No, so I think if you were to kind of look at it overall, I still think we're kind of in a way significantly towards some of the consumer names. That's there. The engineering space, hospitality, travel, tourism is one big area that we are in. We're kind of taking a bet on the upwardly mobile Indian, where there's going to be more spending on these kind of areas. So these are some of the kind of areas or the sectors or themes that we are betting on.
We have to ask you about the IPO market because that's where you've clearly said that one needs to remain cautious because of high valuations, and we talk about this pretty much on a daily basis. What are your top 3 assessment points when it comes to a new issue? Because Matrimony has not done that well, so that gives you a reality check that okay, investors are being realistic, but for a lot of retail investors who look up to investors like you, they will want to understand that what's the best way of looking at these businesses. Right now, the game seems to be listing pops.
Yes.
Maybe with insurance, it's more long term, but give them some sort of guideline.
Unfortunately, in a bull market, it's going to be driven by the listing kind of pops. I mean, I don't think there's really any other variable. I mean, we could be probably very rational and say that when a specific IPO comes in at 40 times, 50 times, 60 times, there is fraud, there is exuberance. But the reality is that when the listing happens, that 40p becomes 50p and 50p becomes
exactly.
60p. So that's unfortunately the reality. So clearly, I think one has to keep in mind that either when you kind of subscribe to an IPO, if you're lucky enough to kind of get that listing pop, you basically have to kind of exit at that point of time because of valuations, and you've made a quick short-term gain.
Have you bought any
right?
IPOs?
No, we can't, because clearly in the HNI segment, or which is the relevant segment for us, that's really where the IPOs are getting oversubscribed.
But after the listing, you've not bought Avenue Supermart, or you've not bought any?
No, we haven't.
Why is Indian retail space buzzing? I mean, you've just come back from America. I'm sure you must have seen the WHJ headlines or the Financial Times headlines. This retailer going belly up, that retailer going belly up. Amazon is the disruptor and everybody's suffering. I look at India, there is a company called DMart which has a market cap of 10,000 crore. Trent has a market cap of 20,000 crore. Future group of companies are up 200% in this year. So why is Indian retail getting this kind of a table thumping response?
I think from the names that you mentioned, I think it might just be very useful to look at, say, how Trent as a stock has done over, say, 10-year time frame. Okay, and I think the data would be very surprising.
It's very good. It's a compounder.
So because even if you kind of go back 10 years back, retail had promise and potential even 10 years back. This company has had the best of pedigree. They've done all the right initiatives, including getting Zara into their fold, and then see over 10-year time frame what's the kind of returns with this stock. So I think when you pay an incredibly high P multiple, it's very likely that you will not make very high returns. I mean, there could be 1 or 2 exceptions, but if you take the entire pack, you will not make those kind of returns. So one has to kind of be cognizant of that. 10 years back, we could have been sitting here and said telecom is the best story in India, okay? And look at what has happened in 10 years, okay? 15 years back, we could have sat here and said technology is the best place to be in because where do you get these growth rates, okay?
But insurance would be one of those growth companies, right?
Yeah, I think insurance is an exceptional because insurance has tremendous long-term stickiness in terms of business. Okay, I think that's a big differentiator. Number one, it's a highly regulated sector. Number three, entry barriers are immense. You just generally will not go and kind of buy an insurance policy from somebody who set up shop yesterday.
So
you're going to look at a lot of credibility.
So we'll summarize the entire interaction in just one line, and that Hindi question will summarize it. Bhai, paisa kidhar banega? You discussed India, we've discussed everything. Now tell me something which is actionable.
One word, equities.
You're talking like
one sentence question as a one word answer, equities.
This is not a macro discussion. That you're not famous for this. You're famous for a stock idea and you're a stock picker. So you should play to your strength.
No, so I think clearly...
Give me an idea, theme or a name.
No, I think one sector which I still think right now has kind of fallen out of favor in the last few months, but I think looks good from a 3 to 4 year perspective is the cement sector. Okay. Look out for tier 2 cement companies which are kind of building in efficiencies, which are growing business, which are kind of taking all the initiatives to kind of grow margins. I think look out for those companies and those companies which are becoming well sized. So I think look out for companies with capacities north of 7-8 million tons. I think that's really where a big opportunity could lie.
Okay, that's enough hint. We'll give it to you for that. Thanks so much for joining in. You should come for longer time frames because we could go on chatting with Nilesh today.
Thank you.